Slide 33. Homework. Find a B-grade setup. Part 1 of 3. This slide shifts focus to B-grade setups during the early overnight session. Your mission is to identify a valid trade that occurred between 6:30 p.m. and 11 p.m. Eastern Time, a window where lower liquidity requires confirmation-based entries rather than aggressive execution. The goal of this homework is to train your brain to recognize when patience is required. B-grade setups are not inferior, they're simply setups where conviction is lower due to environmental conditions like reduced liquidity or session timing. Understanding when to wait for confirmation is just as important as knowing when to enter aggressively. Let's break down the 4 tasks that will help you locate and validate your B-grade setup during the early overnight window. Task 1. Define the early overnight window. Your first task is to define the specific trading window. You're looking for a setup that occurred between 6:30 p.m. and 11 p.m. Eastern Time. This is the early overnight session, positioned between the New York close and the deep Asian session. Here's your criteria checklist for Task 1. First criterion, time window must be 6:30 p.m. to 11 p.m. Eastern. This is after the NY regular trading hours close, but before the Asian session goes into its lowest liquidity period. During this window, you have moderate participation from both late U.S. traders and early Asian market activity. Second criterion, instrument must be ES or NQ futures only. Just like with A-grade homework, stick to the most liquid futures contracts for clean volume profile data. Third criterion, post-NY close volume consideration. Recognize that volume during this window is significantly lower than regular trading hours. You'll typically see volume that's 30 to 50% of NY session levels. This lower volume is why these setups require confirmation rather than aggressive entries. Why this matters. The early overnight session has different characteristics than regular trading hours. Liquidity is lower, spreads are wider, and price action is less decisive. By focusing your homework on this specific window, you're training your brain to adapt your approach based on session characteristics. Different environments require different tactics. Task 2. Identify the level and context. Your second task is to identify which prior day or prior week level was tested during your B-grade setup. Even though this is a lower liquidity environment, the level still needs to have structural significance. Here's your criteria checklist for Task 2. First criterion, prior day or prior week level interaction. Your setup should occur at a major level, prior day value area low, prior day value area high, or prior day point of control. These levels carry memory from the previous session and remain relevant even during overnight trading. Second criterion, volume node visible at the level. Check your volume profile. Even though overall volume is lower during overnight hours, you should still see a volume node forming at your entry level. This confirms that participants are finding value at that specific price. Why this matters. The early overnight session has different characteristics than regular trading hours. Liquidity is lower, spreads are wider, and price action is less decisive. By focusing your homework on this specific window, you're training your brain to adapt your approach based on session characteristics. Different environments require different tactics.
Your third task for identifying a B-grade setup focuses on waiting for confirmation before making your entry. This aspect is what distinguishes B-grade execution from A-grade setups. Here's your criteria checklist for Task 3. First, identify the initial test of the level. This initial test is simply the first candle that makes contact with your predefined level from the prior day. This could be a bearish candle testing support or a bullish one testing resistance. Crucially, this initial test should not be your trigger to enter. It's merely a probe of the level. Second, observe for the confirmation candle. Post-initial test, watch for a second candle that confirms whether the level is genuinely upheld. A long entry at a support level would require a bullish confirmation candle with a strong close, indicating buyer intervention. Conversely, a short entry at resistance calls for a bearish confirmation candle with a resolute close, evidencing seller presence. Third, execute your entry on the candle directly following the confirmation. This technique epitomizes B-grade entry timing. Avoid entering on the initial test or the confirmation itself. Instead, allow the confirmation to fully close, verify robust rejection, and then proceed with an entry on the subsequent candle's open. This three-step process is significant because in lower liquidity markets, the initial test might falter without robust volume holding the level. You could see price probing, perhaps wicking through the level, then reversing on thin volume, making the rejection volatile. Waiting for a confirmation candle helps ensure adequate participant defense at the level, legitimizing the trade. The distinction in timing between A-grade and B-grade. During A-grade setups in high liquidity NY hours, the rejection and entry candles merge. You might spot a strong wick and enter assertively on the following candle as liquidity supports level defense when it holds. Conversely, B-grade setups in lower liquidity necessitate an additional confirmation step because assumption of level hold is imprudent without verification. Moving to Task 4, documenting the confirmation process. This task involves logging not just the entry, but the entire confirmation sequence, a critical aspect of fostering pattern recognition in B-grade executions. Checklist for Task 4. First, screenshots should capture all three candles, the initial test, the confirmation, and the entry candle. All three should be visible on one chart view to observe the sequence clearly. Second, annotate each candle diligently. Label the initial test as initial test, the confirmation as confirmation, and the entry candle as entry. Clear labeling consolidates the three-step B-grade execution pattern. Third, include time and session notes. Mark the exact entry time, confirming it falls within the 6:30 p.m. to 11 p.m. Eastern window to reinforce the session-specific strategy. Fourth, highlight the volume node. Mark the volume node on your volume profile that aligns with your entry price, indicating ongoing interest at that specific level despite broader volume deficiency. Why documentation is pivotal? By documenting the full three-candle sequence, you train your cognitive recognition of the B-grade rhythm. Eventually, on seeing an initial test candle during lower volume hours, your recognition will cue "wait for confirmation" rather than "enter now." This automatic recognition blocks premature entries in thin liquidity contexts.
Now let's step back and understand why this homework matters beyond just finding one trade. This exercise teaches you that trading is not one size fits all. Your approach must adapt to the environment. During the New York session, from 9:30 a.m. to 4 p.m., you have high liquidity, tight spreads, and decisive price action. Levels either hold immediately or they break. In that environment, A-grade aggressive entries work because there's enough participation to defend levels with conviction. You can enter on the trigger candle because the market moves fast and decisively. During the early overnight session, from 6:30 p.m. to 11 p.m., liquidity is 30 to 50% of regular hours. Spreads are wider, price action is slower and less decisive. Levels might hold, but they need more time to prove themselves. In that environment, B-grade confirmation-based entries protect you from false starts. You wait for proof before committing capital. This is the essence of discretionary trading. Understanding that the same setup classification framework applies across all sessions, but the execution tactics must adapt to the specific characteristics of each session. Here's the comparison that matters. A-grade setups during liquid hours. You see confluence, you see the trigger candle, you enter aggressively. Speed and conviction are rewarded. B-grade setups during lower liquidity. You see confluence, you see the initial test, you wait for confirmation, then you enter. Patience and proof are rewarded. Both are valid approaches. Neither is better or worse. They're simply matched to their environments. Action item. Save to your reference library. Once you've completed all 4 tasks and documented your B-grade setup with annotations, save the screenshot to a subfolder called B-grade/overnight within your Golden Setups library. This organizational structure is important. You're not just collecting random trades, you're building a categorized reference library that separates A-grade liquid hour setups from B-grade overnight setups. When you review your library later, you can quickly reference the session-specific examples that match the current market environment. Over time, your library will grow to include dozens of examples across different sessions, different instruments, and different market conditions. This library becomes your pattern recognition training ground. The more examples you review, the faster your brain recognizes setups in real time. Here's the ultimate goal. When you're trading live during the early overnight session and price approaches a prior day level, your brain should automatically shift into B-grade mode. You shouldn't have to consciously think, "This is overnight, I need confirmation." Your pattern recognition should flag it instantly based on the session characteristics. That automatic recognition comes from reviewing dozens of documented B-grade examples. Every time you review your B-grade/overnight folder, you're reinforcing the neural pathways that associate overnight trading with confirmation-based entries. This is how you build intuition that's reliable. You're not guessing, you're training your brain through repetition and documented experience. After 50 or 100 reviews of perfect B-grade examples, the pattern becomes so ingrained that recognition feels instant. Key principle: honest self-assessment. One final note: when completing this homework, be rigorous and honest with yourself. Don't force a mediocre setup to fit the criteria just to complete the assignment. If you look through a week of overnight data and don't find a perfect B-grade setup that meets all criteria, that's valuable feedback too. It tells you that perfect setups are rare and worth waiting for. The goal is not to generate homework for homework's sake. The goal is to train your eye to recognize excellence when it appears. If you only find 1 or 2 perfect examples per week, that's realistic. Quality over quantity. Document those perfect examples meticulously and skip the marginal ones. Preview of the next slide. We'll shift focus to common mistakes that traders make with volume profile setups, how to recognize these errors in your own trading, and implement practical fixes to avoid them going forward. Welcome to Slide 34, Common Mistakes Recognition. This slide identifies 6 critical errors that undermine trading performance and statistical edge. Recognizing these mistakes is the first step to eliminating them. Each represents a deviation from the disciplined, data-driven approach required for consistent profitability. Mistake number 1, fading strong imbalance blindly. This means trading against powerful directional moves without respecting auction state. When the market is in price discovery mode, value is migrating. The POC is shifting directionally, leaving low volume nodes behind. Previous day levels may get run through without meaningful reactions. Don't fade a freight train. Recognize when the market is trending aggressively and trade with the move, not against it. Mistake number 2, stops directly on the level. This is placing stops on VAH, VAL, or POC lines instead of beyond the zone with structure. Levels are zones, not laser lines. Stops placed directly on the level get wicked on routine retests, converting winning setups into stopped-out losses. Always place stops beyond the level with structural room. Use the double tap test we covered earlier to ensure your stop has sufficient buffer. Mistake number 3, demanding exact touches. This means insisting on precise level contact and missing near reactions within 2 to 3 ticks. This perfectionism causes you to miss A-grade setups. Levels are zones with width. A reaction 2 ticks away is just as valid as a reaction at the exact price. If you see a strong rejection candle near the level with volume confirmation, that's your entry trigger. Don't wait for pixel-perfect precision. Mistake number 4, ignoring session characteristics. This is trading London, New York, and Asian sessions with identical approaches. Each has unique volatility, volume, and behavior patterns requiring tailored strategies.
New York offers high volume and strong reactions. Asian overnight offers thin volume and requires more confirmation. London can deliver explosive moves during the overlap. One size fits all doesn't work. Adapt your approach to the session you're trading. Mistake number 5, oversizing on perfect setups. This means dramatically increasing position size when everything aligns. When all 3 factors score a 2, it's tempting to double or triple your normal size. Don't do it. Markets often punish overconfidence. A perfect setup can still fail due to news, algos, or hidden order flow. Maintain consistent sizing within your predefined plan. Discipline beats greed every time. Mistake number 6, treating B setups like A setups. This is entering B-grade setups where trend is against you with the same aggression as A-grade setups. B setups require confirmation triggers and wider stops. If you're trading against the 1-minute or 5-minute trend, you need to see a strong rejection candle, ideally with a volume spike, before entering. Respect the difference. A grade gets aggressive entry. B grade demands patience and proof. Key insight. These mistakes share a common thread, violating the principles of context, confluence, and risk management. Recognition leads to correction. Document when you catch yourself making these errors. Use a trading journal or a simple spreadsheet. Then implement the corresponding fixes from the next slide. Self-awareness is the foundation of improvement. The next slide will provide practical solutions to avoid these mistakes and protect your edge. That's slide 34. 6 mistakes, 6 lessons. Recognize them, document them, and fix them.
Welcome to slide 35, Common Mistakes, Fixes. This slide provides practical, actionable solutions to the 6 critical errors we just identified. Each fix directly addresses a mistake and gives you a concrete implementation step. Let's walk through all 6. Fix number 1, identify state first. This solves the problem of fading strong imbalance blindly. Before taking any trade, determine whether the market is in balance or imbalance. Use the volume profile to read auction state. If you see a migrating POC, shifting value areas, and low volume nodes being left behind, that's imbalance. Trade with the move, not against it. If you see a sticky POC with price rotating around value, that's balance. Fade the edges. State identification is your first filter. It prevents you from standing in front of a freight train. Fix number 2, use zone buffers plus the double tap test. This solves the problem of stops placed directly on the level. Levels are zones, not laser lines. Apply zone width guidelines based on your instrument. For ES, that's typically 2 to 3 points. For NQ, it's 8 to 12 points. Then apply the double tap test. Ask yourself, if price retests this level twice, where would the second retest fail? Place your stop beyond that point. This structural buffer protects you from routine wickouts and keeps you in winning trades. Fix number 3, accept 2 to 3 tick near as valid. This solves the problem of demanding exact touches. If you see a strong rejection candle within 2 to 3 ticks of your target level and you have volume confirmation, that is a valid entry trigger. Don't wait for pixel-perfect precision. The market doesn't care about your exact line. Levels are zones. A reaction near the zone is just as meaningful as a reaction at the exact price. Accept near reactions as valid, and you'll capture more A-grade setups. Fix number 4, use session playbooks. This solves the problem of ignoring session characteristics. London, New York, and Asian sessions have different volatility, volume, and behavior patterns. New York offers high volume and strong reactions at major levels. Use aggressive entries on A setups. Asian overnight offers thin volume and requires more confirmation. Use conservative entries and wait for multiple rejection candles.
London can deliver explosive moves during the overlap with New York. Be ready for quick directional moves. Adapt your approach to the session you're trading. One size does not fit all. Fix number 5. Predefine size by setup class. This solves the problem of oversizing on perfect setups. Don't let emotions dictate your position size. Define your rules in advance based on setup grade. A-grade setups get your standard position size. B-grade setups get a reduced position size, typically 50 to 75% of your A-grade size. This removes the emotional temptation to oversize when everything aligns. Discipline beats greed. Consistent sizing protects your equity curve from catastrophic drawdowns. Fix number 6. Journal decisions to refine rules. This solves the problem of treating B setups like A setups, and it addresses all the other mistakes as well. Keep a trading journal. Document every trade with setup grade, entry trigger, stop placement, target selection, and outcome. Review your journal weekly. Look for patterns in your errors. Which mistakes do you repeat most often? Then refine your rules to address those patterns. Journaling transforms mistakes into lessons. It's the fastest path to improvement. Key implementation principle. Mistakes are inevitable in the learning process. Beginners make mistakes because they don't know better. Veterans make mistakes because they get lazy or overconfident. The key is recognizing patterns in your errors and systematically applying these fixes. Review your journal weekly to identify which mistakes you repeat most often. Then focus on implementing the corresponding fix for 30 days. One fix at a time, 1 month at a time. That's how you build an edge. Bottom line, Slide 34 showed you what to recognize. Slide 35 shows you what to implement. These 6 fixes are not theory. They are battle-tested solutions that will protect your equity curve and improve your win rate. Apply them systematically, and you'll see measurable improvement within 60 to 90 days. That's Slide 35. 6 fixes, 6 solutions. Implement them one at a time and watch your trading transform.
Welcome to Slide 36, Progressive Learning Path. This slide provides a structured roadmap for skill development from beginner to expert. Trading mastery is not a sprint. It's a methodical, layer-by-layer progression. Each stage builds essential skills for the next. Rushing through stages leads to confusion and losses. Progress at your own pace. Master each stage before advancing. Let's walk through all 4 stages. Stage 1, Beginner. This is your foundation phase. Focus on simplicity and consistency. Use daily VAH and VAL only. Ignore POC, ignore weekly levels, ignore overnight levels. Just trade the 2 most obvious levels from yesterday's session. Take A-grade setups exclusively. Don't touch B setups. Don't trade against the trend. Wait for clear alignment across all 3 factors. Default to structure targets. Use the next volume profile level as your take-profit target. Don't try to predict tops and bottoms. Skills building at the beginner stage. Learn to identify clear trends on the 1-minute and 5-minute charts. Practice rejection candle reading. What does a strong rejection look like? Wick at least 50% of the candle body, close near the opposite end, volume spike on the rejection bar. Master stop placement basics. Use the double tap test. Place stops beyond the zone with structural room. These 3 skills are your foundation. Nail them before moving forward. Stage 2, Intermediate. Now you add complexity. Add POC to your analysis. You're now tracking 3 levels from the previous day: VAH, VAL, and POC. Track previous day levels systematically. Mark them on your chart every morning before the session opens. Add overnight profile levels. If you're trading during the New York session, mark the Asian overnight VAH, VAL, and POC. These are key reference points for early New York momentum.
Skills building at the intermediate stage. Introduce B setups with confirmation. You're no longer exclusively taking A-grade setups. Now you can trade counter trend if you see a strong rejection candle with volume confirmation. Learn volume profile level targeting. Instead of defaulting to structure targets, use the next VP level as your take profit. Build a mental database of patterns. After 100 to 200 trades, you'll start recognizing recurring scenarios. Document them, screenshot them, save them to your library. Moving to advanced with insightful emphasis. Stage 3, advanced. This is where you integrate real-time analysis. Add current session developing volume. Use fixed range volume profile with extend right to watch the POC shift, value areas expand or contract, and new HVNs form during the session. Multi-time frame volume profile alignment. Stack daily, weekly, and overnight profiles. Look for confluences where multiple time frames align at the same price level. Weekly plus daily confluence. If weekly VAH aligns with daily POC, that's a high probability level. Mark it, prioritize it. Instructionally, skills building at the advanced stage. Watch POC shifting in real time. If the POC is migrating directionally, that's imbalance. Trade with the move. If the POC is sticky and centered, that's balance. Fade the edges. Identify balance versus imbalance states using auction market theory. Recognize when the market is in price discovery mode versus when it's rotating around fair value. Stack multiple confluences. Use the 5 confluence types we covered earlier: multi-time frame VP, session timing, auction state, HVN overlaps, and level history. The more confluences, the higher the probability. Enthusiastically reaching the final stage. Expert. This is full integration and mastery. Full confluence analysis. You're now stacking all 5 confluence types on every trade. You know which setups have the highest probability and which to skip. Discretionary context reading. After 200 to 300 trades, you've earned intuition. You can read subtle cues in price action, volume distribution, and session dynamics that aren't in the rulebook. Session-specific strategies. You adapt your approach to London, New York, and Asian sessions. You know when to be aggressive and when to wait for confirmation. Concluding with empowerment. Mastery-level skills. Selective aggression on A+ setups. When everything aligns, multi-time frame confluence, perfect trend alignment, strong rejection candle, high volume session, you take larger size and hold for bigger targets. Trust earned intuition. You've documented 200 to 300 trades. You've reviewed your journal weekly. You've refined your rules. Now you trust your discretionary reads. Refined targets and risk management. You scale out at multiple targets. You trail stops. You adapt position size based on setup grade and session characteristics. This is the expert level. Capturing the key message. Key implementation principle. Each stage requires approximately 50 to 100 trades before you advance to the next stage. Don't rush. Beginners often want to jump straight to stage 4. That's a recipe for failure. You need the foundation. You need the pattern recognition. You need the screen time. Progress at your own pace. If you're struggling at stage 1, stay there. Master the basics. If you're crushing stage 2, move to stage 3. Let your results guide your progression. Finally, with a reflective closure. Bottom line, this is not a linear path. You may move forward, plateau, and even regress temporarily during drawdowns. That's normal. The key is systematic skill building. Each stage builds the neural pathways, the pattern recognition, and the emotional control required for the next stage. Trust the process. Master each layer, then move forward. That's slide 36. 4 stages, 1 roadmap. progress at your own pace and master each stage before advancing.
Welcome to Slide 37, Final Recap, the Advanced Framework. This is your complete decision-making framework for professional volume profile trading. Everything we've covered in this course distills into 7 systematic steps. Follow these steps on every trade to execute with clarity, confidence, and consistency. Let's walk through the first 3 steps. Step 1. Classify setup grade A, B, or C. This is your first filter. Determine setup quality before entering. A-grade setups get aggressive entries. B-grade setups require confirmation triggers. C-grade setups get skipped entirely. This classification protects your statistics by preventing low-probability trades. Don't enter until you've classified the setup. This single step eliminates most losing trades. Step 2. Score 3 factors. Use the scoring matrix we covered earlier. Evaluate level history on a scale of 0 to 2. Score 2 if the level is pristine with strong historical reactions. Score 1 if the level showed mixed or moderate reactions. Score 0 if the level is weak or untested. Then evaluate 1-minute trend alignment on a scale of 0 to 2. Score 2 if trend is aligned on both 1-minute and 5-minute time frames. Score 1 if aligned on 1 minute only. Score 0 if trading against the trend. Finally, evaluate rejection candles and triggers on a scale of 0 to 2. Score 2 for a strong rejection candle with a wick at least 50% of the body and a volume spike. Score 1 for a moderate rejection without volume confirmation. Score 0 if there's no clear rejection. Add the 3 scores together. Total score of 5 to 6 equals A grade. Enter aggressively on the first rejection candle. Total score of 3 to 4 equals B grade. Wait for a second rejection candle or additional confirmation before entering. Total score of 2 or less equals C grade. Skip the trade entirely. This scoring system removes emotion and subjectivity from your entries. It transforms discretionary trading into rule-based execution. Step 3. Treat levels as zones, not laser lines. Levels are not precise price points. They are zones with width. Accept 2 to 3 tick proximity as valid. If you're targeting a level and price reacts within 2 to 3 ticks with a strong rejection candle and volume confirmation, that is a valid entry trigger. Don't demand pixel-perfect touches. You'll miss high-probability setups waiting for exact precision. For stop placement, use the double-tap test. Place stops beyond the zone plus structure. Ask yourself, if price retests this level twice, where would the second retest fail? Place your stop beyond that point. This structural buffer protects you from routine wickouts on the first retest and keeps you in winning trades. For ES, that typically means 2 to 3 points beyond the level. For NQ, that's 8 to 12 points. For crude oil, that's 20 to 30 cents. Adapt the buffer to your instrument's typical volatility. That's steps 1 through 3: classification, scoring, and zone-based execution. These 3 steps form the foundation of objective, repeatable trading. Continuing with the final recap, let's cover steps 4 and 5 of the advanced framework. Step 4. Choose targets via hierarchy. Use the targeting hierarchy we covered earlier. Your default target should be the nearest structure. This accounts for approximately 80% of your trades. Structure means the most recent swing high for shorts or swing low for longs. This is the path of least resistance. Price typically moves from one structure point to the next. Your secondary target is the next volume profile level. Use this for approximately 15% of trades. If the nearest structure is very close to your entry, less than 1.5 R, then target the next VP level instead. That could be the previous day VAH, VAL, or POC, or it could be the weekly VAH or VAL. Look for the next significant volume node that offers a realistic profit target. Your fallback target is a fixed risk-reward ratio of 1.5 to 2R. Use this for approximately 5% of trades when structure and volume levels are unclear or too far away. If you're risking 10 points, target 15 to 20 points. This ensures consistent risk-reward discipline even when the chart doesn't provide clear, structural, or volume-based targets. This hierarchy keeps targeting simple and consistent. You always know where your take-profit order goes. Default to structure. If structure doesn't make sense, use VP levels. If VP levels don't make sense, use fixed RR. This removes guesswork and emotional decision-making from profit-taking. Step 5. Stack confluences and follow session playbooks. Seek multi-level alignment. The more confluences you can stack, the higher the probability of the trade. Confluence Type 1, Multi-Time Frame Volume Profile Alignment. Look for weekly VAH aligning with daily POC, or daily VAL aligning with overnight VAH. When multiple time frames point to the same price level, that level has magnetic power. Confluence Type 2, Session Timing. Trade during high-volume sessions. New York regular hours from 9:30 a.m. to 4 p.m. Eastern offers the highest volume and the strongest reactions at major levels. Asian overnight offers thin volume and requires more confirmation. London session during the overlap with New York can deliver explosive directional moves. Confluence Type 3, Auction State. Identify whether the market is in balance or imbalance. If you see a migrating POC, shifting value areas, and low-volume nodes being left behind, that's imbalance. Trade with the move. If you see a sticky POC with price rotating around value, that's balance. Fade the edges. Confluence Type 4, High-Volume Node Overlaps. If current session developing volume shows a new HVN forming at a prior day level, that's strong confluence. Volume is confirming the level in real time. Confluence Type 5, Level History. Pristine levels with strong historical reactions carry more weight than levels that have been tested repeatedly without meaningful follow-through. Stack as many of these confluences as possible. The more you stack, the higher your selective become. The more selective you become, the higher your win rate. Follow session-specific playbooks. Adapt your approach to the session you're trading. New York gets aggressive A setup entries. Asian overnight gets conservative entries with multiple confirmation triggers. London during the overlap gets breakout strategies. One size does not fit all. That's steps 4 and 5, targeting hierarchy and confluence stacking. These steps transform good setups into great setups.
Let's complete the final recap with steps 6 and 7, plus the complete process summary. Step 6. Respect auction state and confirm with developing volume. Before taking any trade, identify whether the market is in balance or imbalance. Use volume profile to read auction state. If you see a migrating POC, that's imbalance. The POC is moving directionally, leaving low volume nodes behind. Value areas are shifting. Don't fade this. Trade with the move. Use pullbacks to broken levels or new high volume nodes as continuation entries. If you see a sticky POC that stays at or near the same price level, that's balance. The market has found fair value. Value areas are expanding symmetrically. This is mean reversion territory. Fade the edges. Sell near VAH, buy near VAL. Target the POC. Confirm your bias with developing volume. Use fixed range volume profile with extend right to watch volume build live during the session. If the POC starts migrating against your planned trade, that's a red alert. Reduce size or stand down.
If a new high-volume node forms at your target level, that's confirmation. The market is validating your hypothesis in real time. Enter aggressively. Developing volume is the market's current voice. Prior levels are historical hypotheses. When the two conflict, trust the real-time data. Step 7. Practice, journal, and earn intuition. Take 40 to 60 trades per day in simulation or micro-contracts. Compress your learning curve with high repetition. Track every trade in a journal. Document setup class, factor scores, session, auction state, entry trigger, stop placement, target selection, and outcome. Review your journal weekly. Look for patterns in your wins and losses. Which setups work best for you? Which sessions offer the highest win rate? Which mistakes do you repeat most often? Refine what works. If you're crushing A-grade setups during New York regular hours, do more of that. If you're struggling with B-grade setups during Asian overnight, reduce or eliminate those trades. Let the data guide your decisions. After 200 trades with strict rule following, you've earned the right to trust your discretionary reads. Intuition is not a gift, it's a skill you build through repetition, documentation, and refinement. Now let's summarize the complete process. This framework transforms volume profile from a simple indicator into a complete trading system. Each step builds on the last to create objective, repeatable decisions. Here are the 4 pillars of the system. Pillar 1. Objectivity. Score-based classification removes emotion from entries. You're not guessing whether a setup is good. You're scoring 3 factors and letting the math tell you. This eliminates overtrading, FOMO, and revenge trading. Pillar 2. Risk control. Zone-based stops and hierarchy targets protect capital. You're not placing stops directly on levels where they get wicked. You're using the double tap test to place stops beyond the zone with structural room. You're not guessing at targets. You're using a hierarchy. Structure first, VP levels second, fixed RR third. Pillar 3. Context. Confluence stacking and auction states improve win rate. You're not taking every level touch. You're waiting for multi-time frame alignment, session timing, and auction state confirmation. The more context you add, the more selective you become. The more selective you become, the higher your edge. Pillar 4. Mastery. Repetition and journaling develop trading intuition. You're not expecting to master this system in 1 week. You're committing to 200 to 300 documented trades with weekly reviews. You're building neural pathways, pattern recognition, and emotional control. Mastery is earned, not given. Here's your call to action. Trade the levels. Respect the volume. Let experience guide your decisions. This framework gives you the structure. Your screen time gives you the skill. Combine the two, and you have a complete professional trading system. That's the final recap. 7 steps, 4 pillars, 1 complete framework. Execute it systematically and watch your consistency improve.
Welcome to Slide 38. Next steps, expectations, and practice plan. This is your roadmap to implementing the Advanced Volume Profile Framework systematically and building consistent profitability. Let's walk through the 3-step implementation workflow, set realistic performance expectations, and review your learning resources. Implementation workflow. This is your structured approach to skill development. Follow these 3 steps systematically. Step 1. Practice volume. Take 40 to 60 trades per day on micros or simulation for 2 to 4 weeks. This is not casual trading. This is deliberate, high-repetition practice designed to compress your learning curve. Rapid repetition builds pattern recognition faster than occasional trading. If you take 10 trades per week, it will take you months to reach 200 trades. If you take 50 trades per day, you can hit 200 trades in 4 to 5 weeks. Use micro-contracts like MES for ES or MNQ for NQ.
Risk $10 to $20 per trade. Max daily risk $500 to $1,000. This keeps financial pressure low while maximizing screen time. Step 2. Track metrics. Log every single trade in a journal or spreadsheet. Document setup class, A, B, or C. Document factor score. Total of 3 factors, 0 to 6. Document session. New York regular hours, Asian overnight, London overlap. Document auction state, balance or imbalance. Document outcome, win or loss, profit or loss in R multiples. Data reveals your edge and your weaknesses. After 50 to 100 trades, patterns will emerge. You'll see which setups work best for you, which sessions offer the highest win rate, which mistakes you repeat most often. Without tracking, you're flying blind. With tracking, you have a roadmap to improvement. Step 3. Refine strategy. Keep what works, trim what doesn't. Review your journal weekly. Look at your top-performing setups. If you're crushing A-grade setups at daily VAH during New York regular hours with a 70% win rate, do more of those. If you're struggling with B-grade setups during Asian overnight with a 30% win rate, reduce or eliminate those trades. Your best setups will emerge from the data. Double down on them. This is how professionals build an edge. They don't guess. They measure, refine, and optimize systematically. Now let's set realistic performance expectations. Trading is not a get-rich-quick scheme. It's a skill-based profession that rewards consistency, discipline, and patience. Here's what sustainable performance looks like. Win rate. 50 to 65% is robust and sustainable. Don't chase 80% or higher win rates. They often come with poor risk-reward ratios. If you're winning 80% of your trades but only making half an R per win, you're not building wealth, you're treading water. A 55% win rate with 1.5 R average wins is far more profitable than an 80% win rate with 0.5 R average wins. Focus on expectancy, not win rate. Risk-reward targets, 1.3 R to 2.0 R per trade using structure and volume profile targets. This is realistic and achievable. Use the targeting hierarchy we covered earlier. Default to structure. If structure doesn't make sense, use the next VP level. If VP levels are unclear, use fixed 1.5 to 2 R. This keeps risk-reward discipline consistent across all trades. Expectancy. Let's do the math. With a 55% win rate at 1.5 R average, your expectancy is plus 0.325 R per trade. That means for every 10 trades, you're netting about 3 R in profit. Over 200 trades, that's 60 R in profit. If you're risking 1% of your account per trade, 60 R equals a 60% account growth over 200 trades. That's sustainable, compounding profitability. Drawdowns. Expect 3 to 5 loss streaks even with a solid edge. This is normal. Even a 60% win rate means 4 losses out of every 10 trades. Sometimes those 4 losses will cluster together. Stay disciplined. Don't increase size to chase losses. Don't abandon the framework after a bad week. Drawdowns test your emotional control. The traders who survive drawdowns are the ones who trust their process and stick to their plan. Now let's review your learning resources. You have a complete educational toolkit to support your volume profile trading journey. Resource 1. This advanced deck. Use this presentation as your reference for setup classification, 3-factor analysis, confluence stacking, and auction state identification. Review slides weekly as you practice. Bookmark the slides that resonate most with your trading style. If you're struggling with a concept, come back to the corresponding slide and reread it. This deck is not a one-time read, it's a living reference manual. Resource 2, Episodes 1 through 3. Go back and review the foundational concepts we covered in the earlier episodes: technical setup, basic strategies, level identification, volume profile fundamentals. If you skipped those episodes or rushed through them, now is the time to revisit them. Advanced concepts build on foundational skills. If your foundation is weak, your advanced execution will be inconsistent. Resource 3, Annotated Chart Library. Build your own collection of A setups, B setups, and C setups with notes. Screenshot every significant trade you take. Label the setup class, factor scores, auction state, and outcome. Save them in folders: golden setups for A-grade wins, learning moments for losses or near misses, B-grade examples for confirmation-based trades. Over time, this library becomes your personal pattern database. When you see a setup on a live chart, you'll instantly recognize it because you've documented 50 similar examples. Resource 4, Community or Discord. Connect with traders using the same framework. Share charts, discuss setups, review each other's trades. Trading is often a solitary activity, but learning accelerates when you engage with a community. You'll see approaches and patterns you might have missed on your own. You'll get feedback on your setups. You'll stay accountable to your practice plan. Final reminder: remember, progress over perfection. You don't need to master everything at once. Start with daily VAH and VAL A setups. Use default structure targets. Trade during New York regular hours. That's it. Don't add POC, don't add overnight levels, don't add confluence stacking. Just master the basics first. Once you've logged 100 trades with daily VAH and VAL A setups and you're consistently profitable, then add complexity. Add POC, add overnight levels, add confluence stacking. Gradually layer in the advanced concepts as your experience grows. The goal is consistent execution of high-probability setups, not hunting for the perfect trade. There is no perfect trade. There are only setups that meet your criteria and setups that don't. Execute the ones that meet your criteria, skip the ones that don't. Trust the process. Respect the volume. Let screen time build your edge. That's slide 38. 3-step workflow, realistic expectations, complete learning resources. Your roadmap to mastery starts here.
All right, so this is the end of the main volume profile course. Now, yes, this course was definitely overkill. And the craziest thing about it is that I'm still not done. I have a ton of more things that I want to show you. But if I'm being honest, it's just extra things, just stuff to spice it up, to be honest. It's kind of how ICT is its own world. Well, so is the volume profile. It's a whole another thing in itself. So you'll probably see me push out a little content here and there. But for now, this is really the main bread and butter here. You're not missing out anything important. And yeah, I made it overkill because I want you guys to be able to reference back to any part of the video in case there's something that you wanted to have cleared up or anything you missed, or maybe you just felt like you don't know volume profiles that well, and just watch over the video again and take a look at them, see if there's something you might have missed the first time you watched it. You never know. There's a lot of good things about it. And but yeah, I just want you guys to know that I really went overboard with it. But you don't have to memorize everything, just enough to where you feel comfortable and you feel like you can master the volume profile. And there's a lot more information on it, but for the most part, this is really my main thing here. So with that being said, I'm going to close it out, but I appreciate you guys sticking till the end, and there's a lot more things coming. And don't forget to check the description down below. You can get a free copy of the entire presentation, and just a bunch of good stuff down there. I promise you'll enjoy it if you click on all the links. All right, let's move on.
We've reached the end of this advanced volume profile course. Before we close, I want to leave you with a message of faith, encouragement, and purpose. The Lord is my light and my salvation. Whom shall I fear? Psalm 27, verse 1. This verse reminds us that in trading, as in life, fear is the enemy of clarity. Fear causes us to overtrade. Fear causes us to abandon our rules after a loss. Fear causes us to doubt our edge when variance strikes. But when you have faith in your process, faith in your preparation, and faith in the framework you've built, fear loses its power. You trade with confidence, not arrogance. You execute with discipline, not emotion. You respect the market's uncertainty while trusting your systematic approach. Strive for progress, not perfection. This is the mindset that separates professionals from amateurs. Every trade is a learning opportunity. Every loss is a lesson. Every win is confirmation of your growing skill. You're not chasing perfection. You're building competence through repetition. You're refining your edge through data and journaling. You're earning your intuition through screen time and deliberate practice. Perfection is a myth. The market will never give you perfect setups every day. You will take losses. You will experience drawdowns. You will have days where nothing works. That's normal. That's trading. The goal is not to avoid losses. The goal is to execute your best setups with consistency and let probability work in your favor over 200, 300, 500 trades. Your volume profile journey starts now. Trade the levels, respect the volume, let experience guide your decisions. The market rewards patience, discipline, and consistent execution. You now have the framework, the setup classification system, the three-factor scoring matrix, the zone-based stop placement, the targeting hierarchy, the confluence stacking approach, the auction state identification, the session playbooks. You have everything you need to trade professionally. But the framework is not enough. Practice will build the intuition. Remember, 40 to 60 trades per day builds mastery faster than months of hesitation. Start small, use micro contracts, risk $10 to $20 per trade. Keep your max daily risk at $500 to $1,000. This removes financial pressure and allows you to focus purely on execution. Trade during New York regular hours. Start with daily VAH and VAL-A setups only. Default to structure targets. Keep it simple. Master the basics first. Stay consistent. Log every trade in your journal. Review your performance weekly. Look for patterns in your wins and losses. Refine what works, trim what doesn't. Let the data guide your decisions. After 200 trades with strict rule following, you will have earned the right to trust your discretionary reads. You will recognize setups instantly. You will feel when the market is in balance versus imbalance. You will know when to be aggressive and when to stand down. That's earned intuition. That's mastery. And trust the process. There will be days when you doubt yourself, when you question whether this framework works, when you wonder if you have what it takes to be a consistently profitable trader. In those moments, come back to this slide, come back to the framework, come back to your journal. Look at your top-performing setups, look at the data. The edge is real, the framework is sound, the only variable is your execution. Stay disciplined, stay patient, stay consistent. 3 final reminders as we close. Volume Profile Mastery. You've learned to read the market's memory through VAH, VAL, and POC. You've learned to identify balance and imbalance through auction state. You've confirmed your bias with developing volume. This is a professional skill that will serve you for the rest of your trading career. Faith-based trading. Trading is not gambling, it's not luck. It's a skill-based profession grounded in data, probability, and discipline.
When you combine that with faith in your process and faith in your preparation, you trade with a calm confidence that no market condition can shake. Consistent growth. You're not trying to double your account in a week. You're building sustainable, compounding profitability. 55% win rate at 1.5 R average equals plus 0.325 R per trade. Over 200 trades, that's 60 R in profit. If you're risking 1% per trade, that's a 60% account growth. That's real. That's achievable. That's the power of consistency. This is the end of the course, but it's the beginning of your journey. You have the map. You have the tools. You have the framework. Now it's time to execute. Go practice. Go log trades. Go refine your edge. And remember, the market rewards those who respect its structure, trust their process, and execute with discipline. Thank you for your attention throughout this course. Trade the levels, respect the volume, let experience guide your decisions, and may your trading journey be marked by patience, progress, and profitability. That's the close. Now, go build your edge.